Ever wondered how some investors consistently outperform the market? It's not about luck. It's about strategy. But what kind of strategy? Welcome to the intriguing world of value investing. This is a strategy that involves buying securities that appear underpriced by some form of fundamental analysis. Now, why does this strategy ring a bell? Well, it's because it's a favored strategy among some of the most successful investors out there. Think of legendary figures such as Warren Buffett or Benjamin Graham. They've successfully navigated the financial waves using this very approach. So, what's the big deal about value investing? It's all about identifying and buying shares of companies that you believe the market has undervalued. And in doing so, you're setting yourself up for potential profits when the market corrects this undervaluation. Value investing, a strategy that has proven successful for many, may just be the game changer in your investment journey. Scene script. Value investing is a simple concept, but it requires discipline and patience. Value investing in its purest form is an investment strategy that revolves around the idea of getting more than what you pay for. It's like shopping for bargains in the stock market. The focus is on identifying and buying stocks that are trading for less than their intrinsic or true value. Let's break it down a bit. Every company has an intrinsic value, a real worth based on its assets, earnings, dividends, and its potential for future growth. This value isn't always reflected in the current market price. Sometimes due to various factors like market volatility, economic conditions, or negative news about the company, the market price of a stock can fall below its intrinsic value. This is where value investors swoop in. They see an opportunity in this discrepancy. They buy these undervalued stocks, hold on to them, and wait. The waiting game is a crucial part of value investing. It's not about making quick profits. Rather, it's about waiting until the market corrects itself and the true value of the stock is recognized. Once the market realizes the stock's true value, its price goes up. And that's when value investors sell their shares, making a profit from the difference between the purchase price and the selling price. But here's the catch. Identifying these undervalued stocks isn't as easy as it sounds. It requires a deep understanding of the company and its industry, thorough financial analysis, and the ability to separate the signal from the noise in the market. It's not about following trends or jumping on the latest hot stock. It's about doing your homework and making informed decisions. Value investing also requires patience and discipline. It's about resisting the urge to sell when everyone else is selling and having the courage to buy when others are fearful. So the secret sauce of value investing is buying low and selling high. Sounds simple, right? But how do we identify these undervalued stocks? Identifying undervalued stocks is where your analytical skills come into play. It's like a treasure hunt where your map is the company's financial statements and your compass, a set of financial metrics. But remember, the treasure you're seeking is not glittering gold but a diamond in the rough, an undervalued stock that the market hasn't fully appreciated yet. Now let's talk about the tools you'll need for this treasure hunt. The first and foremost is fundamental analysis. It's the process of examining a company's financials, its industry position, and market conditions to estimate its intrinsic value. Like a detective, you'll be sifting through balance sheets, income statements, and cash flow statements looking for clues. But what clues should we look for? Here's where financial ratios come in. These are indicators that can give us a snapshot of a company's financial health and performance. Three important ones are the price-to-earnings or PE ratio, price-to-book or PB ratio, and dividend yield. The PE ratio tells us how much we're paying for each dollar of the company's earnings. A lower PE ratio could indicate that the stock is undervalued. Next, the PB ratio compares a company's market value to its book value. If this ratio is less than 1, it means the stock might be undervalued. Lastly, a high dividend yield could suggest that the company is undervalued, as it indicates that the company is returning a good portion of its earnings back to its shareholders. But remember, these ratios are just tools. They are not infallible. They should be used as a starting point for your analysis and not as the sole determining factor. Also, it's crucial to compare these ratios with other companies in the same industry, as what might be considered low in one industry could be high in another. Remember, finding an undervalued stock is like finding a diamond in the rough. It's there, but it takes a keen eye and patience to uncover it. So keep digging, keep analyzing, and who knows, you might just strike gold, or rather a diamond. Scene script. Patience isn't just a virtue. In the world of value investing, it's a necessity. Let's imagine value investing as a garden. You plant your seeds, water them, and then you wait. You wait for the sun to shine, for the rain to fall, for the seed to germinate, sprout, and finally bloom. The process can't be rushed, and neither can value investing. You see, the central premise of value investing is purchasing stocks that are undervalued by the market, stocks whose intrinsic value is greater than their market price. But here's the catch. The market doesn't always recognize this value immediately. It may take weeks, months, even years for the true value of a stock to be acknowledged. And during this time, the price may not reflect the true worth of the company. But why? Why does it take time for the market to recognize the true value of a stock? Well, markets aren't perfect. They're influenced by a multitude of factors: economic indicators, investor sentiment, global events, and more. These factors can cause fluctuations in stock prices, leading to situations where a company's stock is undervalued. Now, this is where patience comes in. As a value investor, you've done your homework, you've analyzed the company's fundamentals, you've recognized its potential, and you've made your investment. And now you wait. You wait for the market to correct itself, for the stock price to rise to reflect the company's true value. You wait for your garden to bloom. It's not always easy. It can be frustrating to watch the market fluctuate, to see your stock's price remain stagnant or even decrease. But remember, value investing is a long-term strategy. It's not about quick gains, it's about steady, sustainable growth. So take a step back, breathe, allow the market to do its thing. Don't let short-term fluctuations deter you from your long-term investment strategy. Have faith in your analysis, in your judgment, and above all, be patient. In the realm of value investing, patience truly is a profitable virtue. Like any investment strategy, value investing comes with its own set of risks and rewards. Let's start with the risks. One of the key challenges in value investing is dealing with market volatility. You see, value investing is all about spotting undervalued stocks and holding on to them until their true value is realized by the market. However, the market is a fickle beast. It can swing wildly from one day to the next, influenced by everything from global economic trends to the latest tweet from a celebrity. This volatility can lead to short-term losses for value investors who may see the price of their chosen stocks fall before they rise. Another risk of value investing is the potential for misjudging a stock's value. This is where the art of analysis comes into play. Value investors need to be able to accurately assess a company's fundamentals, looking beyond the surface to understand its true worth. This requires a deep understanding of financial statements, industry trends, and economic indicators. Get this wrong and you might end up holding onto a stock that's not undervalued but simply underperforming. Now let's talk about the rewards. The potential for high returns is one of the main draws of value investing. When a value investor correctly identifies a stock that's undervalued, they stand to make a significant profit once the market catches up. Think about it. You're buying a stock for less than its intrinsic value. When the market finally recognizes this, the price of the stock rises and you make a tidy profit. But the rewards of value investing aren't just financial. There's also the intellectual satisfaction that comes from doing your homework, making a smart investment decision, and then seeing it pay off. It's like solving a puzzle, where the pieces are financial data and the picture is a profitable investment. Value investing isn't a shortcut to riches, it's a disciplined, patient approach to wealth creation. It's about understanding the risks, reaping the rewards, and always staying focused on the long game. So, is value investing a strategy worth considering? Let's take a step back and reflect on what we've learned so far. Value investing is all about finding diamonds in the rough, those undervalued stocks with significant potential for growth. It's not about chasing trends or quick wins, but rather a disciplined approach to investing that focuses on intrinsic value and long-term growth. This strategy demands patience with the understanding that true value often takes time to reveal itself. It's not without its risks, as any investing strategy is, but the potential rewards can be substantial. It's a method that's been used by some of the most successful investors in the world, and it's one that could lead to considerable wealth creation over time. If you're willing to do your homework and you have the patience to wait for your investments to bear fruit, Value investing could be the strategy that elevates your investment game.